On September 15, 2008, a line of moving vans pulled up outside a glass tower at 745 7th Avenue in Manhattan, and employees carried out cardboard boxes of personal effects while photographers recorded it from the sidewalk. The firm was Lehman Brothers, 158 years old, and it had just filed the largest bankruptcy in American history. $639 billion in assets, gone in a single filing. Most accounts of what happened that week describe a housing bubble that popped. That description is not wrong. It is incomplete. It leaves out the part that matters most. The arrangement that turned a slowdown in American house prices into a $2 trillion global event was built deliberately by named people across 9 years, and almost none of them lost anything when it collapsed. To understand how a mortgage on a house in Ohio became a crisis in Reykjavik and Athens, you have to go back to a signature in the Oval Office in November of 1999. That month, President Bill Clinton signed the Gramm-Leach-Bliley Act, sponsored by Senator Phil Gramm of Texas. It repealed a Depression-era law called Glass-Steagall, which had kept ordinary deposit banks separate from investment banks that traded risk. Robert Rubin, the Treasury Secretary who had pushed for the repeal, left government the following year and joined Citigroup, one of the institutions the new law had just freed to grow. A year later, Gramm sponsored a second bill. The Commodity Futures Modernization Act of 2000 exempted a category of financial contract called a derivative, including something called a credit default swap, from regulation by either the Securities and Exchange Commission or the Commodity Futures Trading Commission. Clinton signed that one too, in his final month in office. The banking industry argued both laws would let American finance compete globally, and for years the argument looked correct. Lending expanded. Home ownership rose. Alan Greenspan, chairman of the Federal Reserve, held interest rates near historic lows after the 2001 recession, and the cost of borrowing against a house fell with them. None of this was hidden. It happened in Congress, on the record, with the banking industry's lobbyists in the room. Here is how the arrangement actually worked once the legal walls came down. A bank would issue a mortgage, often to a borrower with poor credit or undocumented income, in what the industry itself called a subprime loan. Angelo Mozilo, the chief executive of Countrywide Financial, built the largest subprime lender in the country on exactly this model, pushing loan officers toward volume over verification. The bank did not hold most of these mortgages. It sold them, bundled into a mortgage-backed security, to investment banks who packaged thousands of them together and sliced the package into layers, called tranches, ranked from safest to riskiest. Some of the riskier layers were then repackaged again into a new instrument called a collateralized debt obligation, or CDO. Every one of these instruments needed a rating before pension funds and banks around the world would buy it. That rating came from Moody's, Standard & Poor's, or Fitch. And here is the detail most accounts leave out. The rating agencies were paid by the banks issuing the securities they were rating. Large sections of mortgage debt built on undocumented loans received the same AAA rating as United States Treasury bonds. One more layer sat on top of this. The American International Group, through a small London division called AIG Financial Products, run by an executive named Joseph Cassano, sold contracts called credit default swaps against these securities. Insurance against default, in effect, without the reserve requirements that actual insurance carries, because the 2000 law had exempted them. By 2007, AIG's swap book on this material alone exceeded $500 billion, and almost nobody outside the division understood how exposed the company had become. None of this required anyone to break a law. The rating agencies were operating under a business model called issuer pays that had existed since the 1970s and had never before been tested at this scale or with this much conflict built into it. If Moody's rated a bank's securities too harshly, the bank could simply take its business to Standard & Poor's instead. The agencies knew this. Internal emails later surfaced in congressional investigations, showing analysts joking that a given deal could be structured by cows and still receive a top rating. Home prices in the United States peaked in mid-2006 and began to fall. Subprime borrowers, many on adjustable loans that reset to higher payments, started missing them. In June of 2007, two Bear Stearns hedge funds built almost entirely on this mortgage debt collapsed. New Century Financial, once the second-largest subprime lender in the country, filed for bankruptcy 2 months earlier. By March 2008, Bear Stearns itself was insolvent, and the Federal Reserve brokered its sale to J.P. Morgan Chase at $2 a share. Through the summer, the losses spread through banks that had never made a single mortgage loan, because they held the securities built from them. On September 7th, the government placed Fannie Mae and Freddie Mac, the two largest mortgage guarantors in the country, into conservatorship. 8 days later came Lehman. Treasury Secretary Henry Paulson, formerly the chief executive of Goldman Sachs, declined to arrange a rescue. The next morning, September 16th, the Federal Reserve extended an $85 billion loan to AIG, which would grow past $182 billion before the crisis ended, because the swaps Cassano's division had written could not be allowed to fail without taking the rest of the financial system with them. Credit stopped moving. The commercial paper market, which companies use to make payroll, froze within days. Over the following 2 years, roughly 8.7 million Americans lost their jobs. Close to 10 million homes entered foreclosure. The Government Accountability Office later estimated the crisis cost the global economy in the neighborhood of $2 trillion in lost output. In a suburb outside Cleveland, a woman named in later foreclosure filings watched a sheriff's notice go up on a door she had made payments on for 11 years, for a loan whose terms she had been told, at closing, that she did not need to fully understand. On paper, the system that failed that week had multiple layers of protection: underwriting standards at the mortgage bank, due diligence at the investment bank that packaged the security, an independent rating from an agency with no stake in the outcome, and a functioning insurance market behind all of it in the form of credit default swaps. In practice, every one of those layers had been weakened or removed by the same set of decisions made between 1999 and 2004, and nobody occupying any single layer was positioned to see the whole structure at once. Congress approved $700 billion in bailout funds that October under the Troubled Asset Relief Program. Within months, the firms that had received it paid out roughly $20 billion in bonuses to their own employees, according to a later report from the New York State Comptroller. Richard Fuld, Lehman's chief executive, testified before Congress and was never criminally charged. He kept the compensation he had earned in the years before the collapse. Angelo Mozilo settled civil fraud charges with the Securities and Exchange Commission in 2010. He paid $67.5 million. He admitted no wrongdoing. He was never criminally charged. Goldman Sachs settled with the SEC the same year over a mortgage deal called Abacus, paying $550 million. The firm admitted no wrongdoing. Of the thousands of bankers, traders, and executives who built, sold, rated, and insured this material, one senior banker went to prison in the United States. His name was Karim Sarageldin. He worked at Credit Suisse. He served 30 months. Not for the crisis, for mismarking the value of bonds on his own book. That is the entire record of imprisonment for the largest destruction of household wealth since the Great Depression. Every piece of the mechanism that produced 2008, the separation of risk from the institutions that create it, the rating of debt by agencies paid by the debt's issuer, the insuring of that debt by firms holding no reserve against it, survives today in a modified form. The Dodd-Frank Act of 2010 added disclosure requirements and moved some derivatives onto public exchanges. It did not restore Glass-Steagall, and the market for credit default swaps, though smaller, still trades largely over the counter, on terms the public cannot see. The mortgage on the house in Ohio was never the cause. It was the material. The cause was a structure built in daylight by named people that separated the reward for taking a risk from the cost of it being wrong. Nobody involved in that separation broke the law they had written for themselves. And that, more than the size of any single number in this story, is the part of 2008 that is still running. If you made it this far, you now understand something about 2008 that most people who lived through it still don't. Not a headline, but the machinery underneath it. Drop a comment if you followed the whole chain from that signature in 1999 to the sheriff's notice in Ohio. This channel exists to trace the financial architecture underneath events everyone thinks they already understand, and putting one of these together properly takes a genuine amount of research. If that's useful to you, subscribing helps more than you'd think. Until the next one.